Welcome to our channel globalEnxa, where we unlock the secrets to success in the world of import-export business. Ever wondered how import-export businesses decide on their prices? It all starts with budgeting and pricing strategies. In the fascinating world of international trade, financial management takes center stage. And the first act in this play is undoubtedly budgeting. Budgeting is a way for businesses to estimate and plan for various expenses. These may include sourcing costs, transportation fees, customs duties, and other operational expenditures. It's a crucial process that provides a roadmap for your business, helping you navigate the complex terrain of import-export operations. But budgeting isn't just about counting costs. It's also about setting the stage for the next critical action, which is pricing. Now, pricing isn't as simple as just marking up your costs. It involves a fine balancing act, a dance if you will, with various factors playing their parts. Imagine yourself on a dance floor. In one corner, you have market demand. It's the rhythm of the market, the pull and push of supply and demand that guides your steps. In another corner, you have competitor pricing. You need to keep your eyes on them, match their steps, or risk falling out of sync with the market. Then you have currency fluctuations. They're like the unpredictable partner who keeps changing the dance steps. You need to be ready to adapt, to move with the changing rhythm. And finally, there's your profit margin. It's like the spotlight on the dance floor, the ultimate goal of your performance. Your task is to dance with all these factors, to balance them in such a way that your pricing is competitive, yet profitable. It's not an easy dance, but with the right strategy, you can perform it with grace and finesse. So keep in mind, as you step onto the dance floor of the import-export business, your budget is your choreographer, and your pricing strategy is your dance. It's a dance of numbers, of costs and prices, of risks and rewards. And the goal? The goal is to strike a balance between competitive pricing and maintaining healthy profitability. Remember, the goal is to strike a balance between competitive pricing and maintaining healthy profitability. Moving on, let's tackle the elephant in the room, risks in international trade. As with any business venture, international trade comes with its share of risks. Some of these are unavoidable, but don't let that intimidate you. We're talking about them to understand and manage them better, not to scare you away from the exciting world of global commerce. First up are currency fluctuations. Exchange rates can fluctuate wildly, and these shifts can significantly affect your profits. Imagine agreeing to a price in a foreign currency, only to find that by the time you get paid, the exchange rate has moved against you. Suddenly, you're making less than you expected. To mitigate this, some businesses use hedging strategies, essentially locking in an exchange rate for a future transaction. Next, we have political instability. In an ideal world, politics would have no effect on business. However, we know that's not the case. Political unrest, changes in government policy, and even international relations can have serious implications for your import-export business. Diversifying your markets can help spread this risk, ensuring you're not overly reliant on any one country or region. Then there are trade barriers. Tariffs, quotas, and regulations can all pose challenges to your business. Staying informed about potential changes in trade policies and having a plan to deal with them are vital. Finally, let's not forget about transport risks. Delays, damage, or loss of goods during transit can wreak havoc on your business. This is where insurance comes in. Adequate insurance coverage can protect you against these risks, providing a safety net for your business. Risk management in international trade is all about being prepared. It's about understanding what could go wrong and having a plan in place to deal with it. From currency hedging and market diversification to staying on top of trade policies and insuring your goods, there are many ways to manage these risks. In essence, effective risk management can protect your bottom line from the unpredictable nature of international trade. Now let's talk money. How do import-export businesses finance their transactions and manage cash flow? When it comes to international trade, the role of trade finance options cannot be overstated. These financial instruments bridge the gap between exporters and importers, ensuring transactions are completed smoothly while managing the risks associated with trading across borders. Let's dive into some of the most common financing options. First, we have letters of credit. These are essentially guarantees from a bank, asserting that a buyer's payment to a seller will be received on time and for the correct amount. If the buyer is unable to complete payment, the bank will cover the full or remaining amount. Next, we have documentary collections. This is a transaction whereby the exporter entrusts the collection of payment to the remitting bank, which sends documents to a collecting bank along with instructions for payment. Funds are received from the importer and remitted to the exporter through the banks involved in the collection in exchange for those documents. Additionally, there are export financing programs. These are often government-backed initiatives designed to support businesses that are exporting goods and services overseas. These programs can help businesses secure working capital, guarantee loans, and protect against non-payment. But it's not all about getting funds. How you get paid matters too. Choosing the right payment methods is a balancing act between risk and cost-effectiveness. You want a method that is secure but that won't break the bank in transaction fees. And you need to consider the credit terms. Will the payment be upfront, or will it be a credit sale with payment expected at a later date? Consider the trustworthiness of your trading partner when selecting a payment method. Are they reliable? Do they have a solid credit history? These are crucial questions to ask to avoid payment issues down the line. Choosing the right financing and payment methods can make a world of difference in managing your cash flow and reducing transaction risks. With the right strategies in place, you'll be well on your way to running a successful import-export business. To wrap things up, let's summarize what we've learned about financial management in the import-export business. Firstly, budgeting and pricing serve as the foundation of your financial strategy. Budgeting involves predicting and managing expenses, from sourcing and transportation to customs duties and other operational costs. Meanwhile, pricing is about balancing market demand, competitor pricing, currency fluctuations, and profit margins. The goal is to remain competitive while ensuring your business's profitability. Then, we dove into risk management, a vital part of international trade. Risks can come in many forms, from currency fluctuations and political instability to transportation hiccups and trade barriers. Effective risk management involves not only identifying these risks, but also devising strategies to mitigate them. This could mean purchasing insurance coverage for various risks, or diversifying your product portfolio and markets to reduce dependency on any single source. Lastly, we explored the world of trade finance and payment methods. Trade finance options like letters of credit, documentary collections, and export financing programs can help facilitate international transactions and manage cash flow. When it comes to payment methods, it's about finding a balance, one that minimizes risks and is cost-effective for both buyer and seller. Factors like trustworthiness, transaction fees, and credit terms all come into play here. In essence, financial management in the import-export business is like navigating a complex labyrinth. You're constantly forecasting, balancing, strategizing, and optimizing. It's a challenging yet rewarding process, one that can significantly impact your business's bottom line. Remember, in the world of international trade, effective financial management is not just beneficial, it's essential for your business's success. Thanks for watching. Don't forget to like, share, and subscribe for more valuable content.